So this is going to be kind of just a panel session. I have a bunch of questions that are kind of planned to explore the differences between debt and equity financing. And we'll go through it. Kind of feel free to ask questions if you want us to dive a little bit if needed. And then time permitting, we'll go maybe talk about a couple scenarios and see, what what funding might be appropriate for these scenarios. And then we'll wrap it up with just some general kind of Q&A. And then it'll be an opportunity to kind of, follow up with each of us independently, afterwards or, separately, later on. So, feel free to engage with us as well. So first I want to say thank you, welcome. And the first question is, and one little caveat here. I'm going to ask the panelists to kind of focus in general about your type of financing and not necessarily, your firm's, policies or, requirements, just kind of keep it at a high level. And also to the audience, just a reminder that don't necessarily take what they say or what we say as verbatim. Financing is a very complex decision-making process, and we might be commenting on just one particular scenario or one particular aspect that may or may not apply to your specific business. So that's why it's very important to have that one-on-one conversation. Don't come up to us afterwards and say, "Hey, I'm that scenario. Can you fund us?" Because it gets more complicated than that.
People do that to me all the time. It's fine.
I just don't like being cornered and say. So let's start with some fundamentals. And both debt and equity provide capital into a business, but the difference is kind of in there. As a lender or as an investor, what do you expect? What are you looking for? What's your expected return? Why are you doing what you're doing?
Great. I'll go first. So I'm Julianne Brand with the Oregon Venture Fund. We are the largest and most active venture capital fund based here in Oregon. The quick 30 seconds on us, we invest between $500,000 to $2 million in any one early stage startup. And we only invest in entrepreneurs here in Oregon, and we invest in every business model, market, technology, industry. And we do that because we have a collaborative fund model where we can utilize the folks who invest in our fund to help make investment decisions. So we're investors in Green Zebra, and one of the reasons we invested in Green Zebra is because the founders of New Seasons are investors in our fund, and they helped us identify and understand why that was a great venture capital investment. So that's kind of the lens I'm coming from. I'll do my best to kind of talk about probably early stage venture capital investing rather than kind of later stage, because I get the sense that that's where most everybody is at. And the question is about equity in general.
Right. What do you look as an equity investor? What do you look for?
So as a venture capital investor, when you're taking on an equity business partner, they own a portion of your business. So much like folks who are co-founding a company or who maybe bought out another founder, when you take an equity investor on in your business, they are going to want to be partners. As a venture capital investor, we typically would own about 20 to 30% of the business when we invest. And the great part about having equity investors in your business is that you have a partner who has skin in the game and a vested interest in your success, because they have literally put dollars into the business and they own, a portion of your business. And so it's in everyone's best interest to grow and scale the business as quickly as possible, and get it as big as possible. The other great part about that as an entrepreneur is that if the business fails and that you lose all your money, you're under no obligation to pay your equity investor back, because they have bought into this idea saying, we believe that this is going to be a huge opportunity, and if things go wrong and we lose all our money, we understand that, which is going to be different than a debt provider. The downside is that the way that a venture capital fund makes money is that we are looking for entrepreneurs who it's not a great fit for every business, and this is why, because we want to invest in kind of high growth, scalable, defensible, and ultimately exitable businesses. So when I say exitable, we only make money when your business sells to another company or maybe goes public because somebody else has decided to buy our collective ownership in the business. So yes, there are other ways that you can get investors out of your business, but when you're taking on a venture capital investor, the understanding is that you want to give up a portion of your business because because the value of your business is going to grow 10 times, 20 times, 100 times. And so everybody participates in the success of the business when somebody else buys the company. And I think I highlight that because for a lot of early stage entrepreneurs, selling your business in 5 to 7 to 10 years is not what everybody wants to do, and not every business is a great fit for that. I think of all businesses formed, about 2% raise venture capital, and some of that is because they can't and people don't want to invest, and a lot of that is because just not every business is a great fit for this type of model. And so I'll stop there because I don't want to go too deep, but the one thing I'll say is that venture capital is this high risk, high reward model. So we anticipate that at least half of our companies will fail, and we're looking for a couple of companies who are going to blow it out of the water and be really successful. And that's how we, as a venture capital investor, makes money. So we can dig in more into that, but that's a little bit behind the why VCs say, oh, we're looking for these unicorns, or looking for, and the why is because it's a high risk, high reward type of investing model.
Okay, thank you. Shelli?
Well, at Wells Fargo, it's a little more kind of dry, not as exciting. Very interesting how you can sleep at night. No. For us, we do look at your typical 5 C's, which will be credit, your personal credit, and that's capacity. Your capacity to be able to repay the debt, which will be your cash flow and whatnot. Your capital is if you have, what type of business you have. And then the conditions would be if there's, if you're looking to refinance a debt, does that really make sense to refinancing? The conditions on why you want the loan. And then the collateral, if it is being collateralized. Not all of our loans need to be collateralized. Usually anything under 100,000, we do have a fairly quick turnaround of approval rate, or I would say application time. It's about 48 hours. Typically, they do run from 0 or from 10 to 100,000. Most of them are in the $25,000 range. And again, that is basically built on your personal credit. We do look at for all owners to be guarantors if they own 25% or more of the business. So even if you had a silent partner, if they own 25%, they do need to be a guarantor on the business loan.
Can you tell us what a guarantor really means?
Sure. So a guarantor is they are signing their name to our debt, that if something happens to the business, they are the next in line to pay that. So when you get a loan with a commercial bank for the business, again, we'll look at your personal credit, but after that, it goes on to the business side of the house, and it's no longer a part of your personal business score unless something happens, unless there starts to be lates or there's some type of collection, then that all gets transferred back to your personal side. But what's nice being able to keep it separate in those good times is if you were to purchase something on the personal side, they're not going to see that business debt. Does that make sense? Yeah, so that's the ideal of working with the bank, because they will separate your business and your personal.
So I want to ask a question here. Is Julianne, you mentioned that you're kind of looking for these high growth businesses, 10x, 20x, 30x growth. Shelli, if someone says to you, I want to borrow money and I want to grow 20, 30, 40 times in the next year or two, what's your initial reaction from a lender's perspective?
The initial reaction would be, we love to hear your story, get your business plan, see what that has to do with it. But basically, we are looking at current and past performances. So ideally 2 years worth of history. So we're gonna look at and then if we do see there's growth in the business, that's what we wanna see. We wanna see that these 2 years have been increasing. If there was a dip, is it because you had a one-time expense? You know, everything needs to be explainable to an underwriter. Everything's, yes.
In your situation, Wells Fargo is not acting as a partner or any sort of equitable investment, is that
Correct.
right? It's just,
Cor-
it's
The
simply the
debt.
loan,
Mhm.
okay.
Yeah, we'll just.
Yeah, and so one thing as a lender, and speaking as a lender, we're actually a little wary when you come to us and say, hey, we want your capital because we want to grow 10 times in the next 2 or 3 years. That's a little too risky for a lender. And usually when someone comes to us and say, we want that much growth, we're gonna direct them to a venture capitalist, because that's, as Julianne mentioned, that's much more riskable, I guess is the right word. I'm a little
Yeah.
tongue-tied here.
Yeah.
But venture capital is for that more speculative, high-growth environment.
Yeah, I might just add, so in the equity camp, there's like not just venture capital people, so so if I think about kind of the trajectory, there's angel investors who are individual investors who are likely your friends and family, and they have to meet a certain accreditation by the SEC, which is really just $200,000 in individual income or $250,000 in joint income, or $1 million in net worth minus your house. But these are basically your friends and family who want to invest in you and your success. And so typically we see companies get equity investors, angel investors at early stages of the business from friends, family, people you used to work with, someone your second cousin's mother introduced you to, like whoever has a vested interest in your success. And then you kind of get the venture capital world, which I talked a little bit about. And then there's like this whole private equity, huge dollar amounts, and then ultimately kind of the public markets. But like I said, we'll kind of focus on, I'll try to talk about the angel and kind of venture early stage stuff, since that's this room mostly.
Can you, sorry, go ahead.
Did you make a distinction between equity investors versus angel investors or venture capitalists?
So the distinction between an angel investor and a venture capital investor, both of them are buying equity in your business. So they are gonna be a 10, 20, 30% owner of your business. The difference though is that an angel or individual investor is going to write a check, a much smaller check, like $25,000, $50,000, $100,000, and they're probably gonna do that when it's just you and an idea. A venture capital investor is gonna wanna see you, a great idea and a great market, and then some traction to show us that we're not crazy for thinking, your business is gonna be super successful.
Okay, so those both fit under the umbrella.
They do, yeah, great question.
With Julianne, with equity, you get a share, the investor gets a share of the business, right? Can you comment a little bit about the control? And there was a question someone asked about a board seat.
Yeah.
When does that come into play?
Yeah,
And how does
sure.
that all work out?
Yeah, sure. So, so when we decide to make an investment in a business, and we can talk more about why we decide to invest in businesses, but when we decide to invest, one of the best things about venture capital, depending on assuming you have a great partner, is that everybody is on the same page with where we want the business to go, because we're all owners in the business. And so because of that, most funds want to take an active role in trying to be helpful and grow the business. So most funds have a specific industry focus, or they have specific partners or investors at those funds who say, I invest in all consumer companies because I invested in Facebook and I have this huge network and can get you, more capital down the road. I can introduce you to all the right people, and I'll likely take a seat on your board. And then the board really is the governing body that runs the company, but their most important role is that they're owners in the business. Usually there's an investor or two has a board seat. Their really only job they can do is hire and fire the CEO though. So the governance of the company happens through the board. So there's monthly board meetings, quarterly board meetings, but all the day-to-day execution is done by the team. And really, again, the only power the board has is to hire and fire the CEO. And we sometimes make investments where we don't take board seats. In the majority of cases, we'll take a board seat, and we can talk more about board dynamics and control, but really the idea is because we want to be helpful, and especially as the company scales and grows, we've invested in 60 companies, and we can draw from that experience to help founders who's often this is maybe their first or second business, so raising money or going through a merger and acquisition is new for them, whereas it's not as new for us.
Shelli, on the debt side, you don't get any control, right?
We get no control.
You get paid back first though, so that's.
If there is collateral involved, we will put a lien on that collateral. So therefore you can't sell it out from under us. So if you are buying equipment, a vehicle, Wells Fargo will have their name on that, or be filing a UCC filing, it's called, and like I said, it's securing that collateral.
So yeah, it's a security that the lender may have, and it's equity investors are actually subordinated. So in the event that the business cannot pay, right, whatever assets may have, those assets are liquidated. They go to the lender first, and then if there's any left over, then they go to the equity investors. So that's the kind of the role. Whereas equity investors get control, right? They don't get anything if the company dissolves, whereas the debt investors, the lenders, they get first dibs because of the collateral that they offer.
You talked a lot about a board, which would imply, corporation.
Mhm.
Does your company invest in other business
Like
entities?
an LLC.
Yeah, or is
Um,
it strictly corporations?
Yeah, we have one investment that is an LLC, and in general, if you're raising money in the next 18 months, you should be a C Corp. And mostly it's just like I actually don't really know a lot of the legal behind it, but we are an LLC. We have to distribute information to our shareholders and our funds. If like your tax documents are late, there can be penalties and fines, I think, for that, but the rule of thumb that our lawyers tell us is if a company is gonna raise money in the next 12 to 18 months, a C Corp is the best way to go about that. The one reason we have an LLC is because that company might pay us distributions because of a royalty agreement they have, given the sector that they're in. We were only comfortable doing that because they have another VC lead investor who has a ton of experience with making investments like this because it's in life science, but we wouldn't do that without another investor leading that for us.
And then same for you both, does the business entity type matter as far as the loan?
No, it doesn't. So a lot of people think if they've incorporated that they don't have to be the guarantor because it would be just the business. But that only comes to play is when you no longer are the owner of the business and you've sold it and it's, being traded on the New York Stock Exchange, then you're no longer the guarantor of it. But every small business owner, if you want a loan, you are the personal guarantor of it. Therefore, you could be in any capacity, LLC, sole prop, however you want to structure
There
your
is a
business.
little difference between sole prop because the funding is going to the individual as opposed to an entity. So there's a little nuance there, but yeah, whether it's LLC, C Corp, S Corp, we have the same kind of loan papers and it's sufficient.
Just a tangential question about boards, but at what size of revenue do you see boards being created? I mean, you're talking about having seats on boards, but do you see any kind of pattern in terms of revenue?
Yeah, half the companies we invest in are pre-revenue and half are not. And in almost every case, when you raise money from an outside investor, you will have a board. And typically a pre-revenue company board is gonna be 3 people. It'll be one investor, the CEO of the company, and maybe the other co-founder or an independent board member. And then if you have a couple $1 million in revenue and maybe you raise $3 to $5 million, you'll likely have a 5-person board because there'll be 2 investors, the CEO, another person at the company, and then an independent board member.
You have a question?
It was on the C Corp, thank you, which I'm not familiar with, actually, so I would just love a quick definition of what is the distinction between the C Corp and LLC and why is it preferential in the next 12 to 18 months to be a C Corp?
I actually don't know the answer to that question. Do you know
The,
the
the
answer?
quick answer is that C corps allow for shares, and that's kind of,
Oh, sure.
you know, I mean, LLCs also have shares, but it's more like a
Right.
membership partnership, so it's a little bit different.
Okay.
And so I had a business prior to here, and it was a C corp for a variety of reasons. But, you know, I was a share owner of the business along with my business partner, and, you know, we could sell shares, you know, to other parties or to each other if needed, whereas an LLC, it's more of a membership partnership agreement.
Yeah.
That's about the limit I know.
Okay, learn something new, yeah.
All right, so let's switch over a little bit, talk about what's kind of fundable, and you know, in terms of the type of funding, how it's used, the type of clients. Shelli, I'll start with you. What's an ideal, well, maybe not ideal, but what's a typical fundable business project opportunity that is very nice for debt?
So most businesses want a working line of credit because they sit down and they say, I need working capital. Well, you need to be able to define what that working capital is a little deeper. You know, that's a great catch-all phrase. So if you could tell me it's because you're in a growth phase, you need to hire an employee, you need to be able to pay that employee for at least 6 months out of this loan. If you are wanting to purchase inventory because you are told that if you buy it this month, you're gonna get a 20% savings, you know, something to really tangible for that working line of credit. And then we also like to see that working line of credit get paid off within 12 months. It's still available for you, but it is a line of credit so that the banks really wanna see you using it and paying it back. The typical business owner who gets a line of credit can be a wide range. It could be really any of your businesses. The only thing that we really are not able to lend on is cannabis. Unknown caller. Sorry, I thought I turned it off.
There's a cannabis startup. Somebody walked in there, yeah.
Yeah, so anything along the cannabis, and no matter whatever you call it, we still have ways of learning that it's cannabis.
Even with the credit card, yeah.
Yeah. Hydroponics, you know, any of those. But you know, so if you personally have like 5 pieces of credit for 5 years, that's great. That's really what we're looking for, that you already know how to handle debt. And your business, if it is a brand new business, it's a higher risk for the bank, so it would be a shorter term line of credit, but normally a line of credit is very similar to your credit cards. It's available to you, you pay it back, and it's revolving. And back on credit cards, that's really where most business owners start, is on a business credit card. And that's a great way to finance your day-to-day expenses.
Can you comment on something a little bit larger, let's say more than $50,000, and what do you look for in the business in terms of profitability, in terms of just trending, you know, what's an ideal fundable business? Some high-level characteristics.
Okay, so again, we like to see an increase of sales. If there is a seasonality, that there's explanations for that seasonality, that you know, and that you have also put skin in the game. So if you come to us and say you are looking for a $50,000 line of credit or loan, and I ask you, how much have you put into your business? And you say, oh, I've put nothing into my business. That right there is telling me you don't have a lot of faith in your business, that you haven't put your own backing into it. So we really like to, you know, there's no partnership, but we like to see that you are holding more debt to the business than we are holding.
Do you look at any particular ratios for that?
There's really no hard black and white ratios to it. Again, it's what you need the money for and that you're able to quantify why you need it.
And let me just add to that, a lot of times when you're looking for debt, everybody starts focusing on ratios, right? And because it's easy. But the reality is that there are millions of different ratios out there, right? And lenders have their own preferred method for evaluating loans. But the bottom line is that they want to be able to have confidence that you can repay the loan whenever the loan is due or matures. So there are many different ways of analyzing the financials to assess that ability. So as you're talking to lenders, kind of focus and keep in the back of your mind, how am I going to repay the loan? How am I going to convince the lender that I can repay the loan? So
Yeah, if there's a secondary source of income, that's great. You're in business for yourself, but your partner, your spouse, or, significant other has a steady job, and even though they're not part of the business, we'll still take that in consideration as secondary source of income.
Is there a time, obviously time frame of when businesses start will vary, but is there sort of like we won't touch you if you're in your first 6 months or if you're in your first year? Is there any sort of time frame?
Generally, if you're under 2 years, our recommendations first would be like a business credit card.
Okay, that's good to know. Okay.
And when you're a young business, I think there's two things. One is that depending on your situation, you might be able to get a personal loan, right? Not the business, you, a person, get a loan. Maybe you have a home equity in your home and you can tap into, and the lender will give you access to capital through that, and then you can funnel that through your business. And then the other thing is, one of the things that we kind of focus on is young businesses, right? Before they're 2-3 years old of profits, we may have the ability, depending on your situation, to bridge that gap. And then at the end of our loan, we can hand you off to a lender. Is there another question?
Yeah, so you were mentioning that if a spouse has a steady job and good income, even if they're not a part of the business, that could come into play. Is that only if they are a co-signer, or does that matter just to show that, your personal finances are being met in another way?
Yeah. They'll look at it just because they'll be looking at your tax returns and they'll see it as a secondary source of income, even if they're not an owner of the business.
But that co-signing will vary from lender to lender. So if we do a loan which the co-signer's income or the spouse's income is part of, the way we underwrite or evaluate the loan, we're gonna require that the co-signer be a personal guarantee. But again, that's something will vary from lender to lender and will vary from situation to situation.
So I apologize, I came in a couple minutes late. Who do you represent?
Oh, sorry. I'm with Ascent Funding. So we're a nonprofit small business lender that is a kind of alternative lending.
Yeah, I was gonna say, can I paint a scenario? There's a number of food and beverage companies I work with or know. They've got $100,000 maybe in revenue, or between 100 and 500,000 revenue. And they get a big new client, like a Whole Foods for 100 stores or a Walmart or something of that ilk, right? And they need to identify a line of credit to finance inventory purchases. But what kind of options or solutions do they have available? I mean, I was talking to 5 different companies yesterday, and this scenario was exactly real. So I was just curious what kind of thoughts, advice, solutions you would provide.
Yeah, and before we answer that, I think, that's a common scenario, not only about food and beverage, but I know there's a few of you here that are manufacturing. It's kind of the same thing. You need that capital to make, produce, purchase that inventory, and what do you do? So we can kind of skip a little forward and talk about scenarios. Is maybe Julianne, what is the equity investor's perspective of funding inventory?
Yeah, I'll say we love debt, and we have investments in consumer product companies, food and beverage companies, IoT, so they have a software and a hardware component. And in every single one of our investments in that space, they all have access to a line of credit, whether it's a revenue-based loan, maybe it's based off inventory, or maybe they have some sort of venture debt. So all different flavors, but all of those companies have debt. And that's exactly because an equity investor really wants to be investing in parts of your business that help grow the business to that kind of high growth we're looking for. So we really like to invest our dollars in things like sales, marketing, hiring new people, so you can learn how to spend $1 into your business and get $5 in return. We like to spend our money less on you buying, the components that maybe have to go into you being able to get that off the ground. Say inventory, that helps you kind of fund those first pieces of your business. Don't get me wrong, we certainly do, venture capital dollars do go toward things like buying product to sell to customers or buying hardware to then, add software onto. But that is in our opinion, that's a great opportunity for debt to come in alongside equity.
And for us, if you came in with a lot of contracts, we would be guiding you more towards a factoring company, because that is something what banks are not able to lend against, would be contracts. Because to us, that's not something that's tangible to where we could really put a lien on that.
There are, though, if these companies have $100,000, $500,000 in revenue, they're revenue-based loans. The state of Oregon does them, a number of other organizations in town. So, because they have a vested interest in the success of these companies. So, those are great options, I would say, for a business like that. There are also some like angel investors who might want to invest into equity in the business, or they might be interested in providing debt to the company, giving them a loan of $100,000 that would get paid back in 12 to 18 months. So that's a creative solution to your problem, though.
And let me just also add about inventory, again, whether it's food or, cups or hats. One of the nice things about lines of credits is the inventory needs are kind of revolving, right? You make that upfront purchase and then hopefully you get sales, and those sales will come back into the company. That works very nicely with a line of credit because you access that capital, you make that initial inventory purchase, right? And then the sales comes in, then you take that capital and repay or pay down that draw. And it kind of evolves. And so that's a scenario that Shelli was mentioning, is it's a revolving line of credit. It kind of ebbs and flows with your business. So that's the scenario where debt works, really nicely. So I think one of the other challenges with getting a line of credit that I think a lot of these young businesses have is the collateral. The lender will ask for collateral in the business, right? Or for the loan. And a lot of young businesses just don't have that asset base to, pledge against the loan. And so that's where organizations like us, we can be a little bit more flexible with the collateral requirements. Sometimes we can work with government agencies that provide some type of loan guarantees to help mitigate some of that risk. So you're gonna have to get a little creative there, but that's where organizations like us kind of come into play. Yeah.
Question about collateral. So if a business is, a software business or something where most of the assets are intangible, how does collateral work, or is that really mostly just applicable to businesses that have physical?
It doesn't. So unfortunately, the intellectual property, from a collateral perspective, I mean, just quite frankly, it's only valuable to a lender when the loan defaults, right? When you can't pay a loan, the lenders wants to acquire those assets that it has access to and liquidates them, right? So if it's a car, it's a vehicle, it's a house, those are physical assets that a lender can access, acquire, and liquidate to recoup some of that lost investment. Unfortunately, in most cases, intellectual property, software, it's very difficult to liquidate those assets. And so, a lot of lenders, if they accept it, they're going to discount it significantly. You might value that asset as $100,000, and the lender says, if I liquidate this, I'm only going to get $5,000. And that's the same thing with inventory. A lot of times, manufacturers say, "Oh, I got plenty of inventory. It's worth $100,000 of inventory that I can offer as collateral." Well, that's great if you can sell it, but if you default on the loan, it kind of means that you couldn't sell that inventory. And so how do you expect a lender who doesn't have, any networks in, your industry to liquidate those assets? So the challenge with inventory as collateral is that a lender is going to discount that also very significantly, unless your inventory is like gold bars or something like that. But chances are that's not the case.
So two debt options for software companies that we've seen to be successful. Well, first, a lot of software companies raise equity either from angel investors or venture capital investors. But we've seen two things. One, revenue-based loans, but you need to be at least $1 million in revenue or more. There's an increasing understanding about how SaaS business models work. And so there are providers who are providing loans specifically for like SaaS, ARR, MRR-based revenues. The other one we've seen is venture debt, and that is when you have a venture capital investor who is investing in your business. There are loan providers like Silicon Valley Bank that will invest debt alongside that venture because their bet is if you go under, the business can't pay it back, but you have investors who are going to carry your business and keep writing checks in the company, which, so two very different models, but both debt models that you could look at down the road.
I have a question for you. Can you kind of walk us through like a VC giving, like saying like, we're gonna invest in you and where we want you to grow like 10x or 20x, which I hear a lot, but what is that exactly? Like what is that timeline of like, okay, now like we've invested in you and like, are you just handing over a check or is it given in tranches? Is it kind of, I don't know if you're gonna come back later, but just my kind of, I feel like I don't really understand the nitty gritty of it, so like what exactly happens? So say like the investor, the VC is like, well, we have this network and you should meet all these people. And then, but then who's kind of making these decisions, right? Business owners, you know what I'm asking.
Can I ask you to broaden that question a little bit?
I'm
To
gonna
talk
do the
about
whole
the
thing.
process from like the first meeting through.
So we're venture capital investors is this high risk, high reward model, and we know that the failure rate for startups is so high that we need a couple big winners to make up for the failure. So that's why why we're in this world and what we're looking for. So the process looks like this. I'm looking for highly defensible, highly scalable, highly exitable businesses and teams that are rock stars that can execute on this idea. So maybe we have a meeting, we're starting to get to know each other. Maybe I'm offering some advice about people you should meet or introductions you should make. And then there's a point at which for us, when we're writing checks of $500,000, maybe you've got this rock star team and a great idea and some evidence that there's product market fit. If we're writing a $1 to $2 million check, I want to see a rock star team, a large and growing market, and traction that there's really a product, that there's really a need for the product you're building, that the problem's really big. So to get that bigger check, there needs to be a little bit more behind it. And so when I say, great, you're a consumer product chai company, right? So we just invested in Farmhouse Culture is an investment we made in a food company, and they actually were doing a couple $1 million in revenue at the time that we invested. And so we had a rockstar team. They had built and sold food businesses before. They're building a probiotic food platform by taking sauerkraut and putting it into other food products. And we know that probiotics is a huge trend in the market. And they had a few $1 million in revenue, so there was some traction. So we did 4 weeks of what we call diligence, and that was digging into, we've built a relationship over 6 months, 12 months. In this instance, we actually knew the team for a couple of years. And so when I know that you're ready to raise money and we've both decided we like each other, when I go into diligence, I'm looking for everything that could go wrong in the company. So when I say like, we want to invest in your company, the first meeting I go to with you, I'm going to believe everything you say. And then the second meeting we go to, I'm going to believe nothing you say, because it is my job to both understand the opportunity and also think about all the reasons why it is risky and also uncertain. So that diligence looks like analyzing your market, talking to potential customers or current customers, trying to understand how big the problem is, what your competitive landscape looks like. There's like a whole checklist I could send you. But during that time, we're getting an understanding of what do you think the growth plans for the business are. Now, I wouldn't go to a company and say, we think you should be tripling in growth every year. But if an entrepreneur comes to me and says, because we have these 5 contracts lined up with Whole Foods and New Seasons, we know we're gonna go from $500,000 in business today to $2 million tomorrow, and this is what the plan looks like from here. As an investor, it is my job to support you in your growth plan, not dictate a growth plan to you. And there should be a mutual understanding when we make an investment. Yes, we know it's gonna take longer and cost more than you think it's going to. But we've kind of mutually decided, because you've come up with this plan, and I believe it relatively, that in year 1, you're gonna have $1 million in revenue, but in 5 years from now, you're gonna have 10 times that, or maybe, 20 times that. So it should be a conversation, and one that kind of we agree upon before, then we help you execute that vision. Maybe just briefly about this, but the reason why we like to say 10x in 10 years or less is because we have written in documents with the investors who invest their money in our fund to say, in 10 years or less, we're gonna return 3 times your money to you. And that's gonna be over those 10 years that we're writing you checks, because our companies have built and sold. So that's why that's what venture capital is. We have this like hard term cycle on the times that we invest. So I don't know, does that answer your question a little bit better?
Well, cause there is a little bit of like a negative connotation with like taking VC money with like,
Sure.
they're gonna control your business, they're
Sure.
gonna now dictate what you should do,
Sure.
and like, what if their strategy is you need to be in every Walmart, but you're like, that's not where we're looking to be, and
Sure.
that doesn't go with our mission, or maybe with our kind of like what we wanna do as a business owner.
Totally.
And like, can you just speak a little bit on that?
Yeah.
Because
So
that's important.
when an investor is doing diligence on you, I want and like and expect a founder to be doing diligence on us too. So you should be calling companies we've invested in. You should be talking to other people who maybe we said no to. And the whole idea there is that you're looking for a partner in your business just as much as I'm looking for, companies to invest in. And yes, you are absolutely right that investors are on your board. They could help drive strategy decisions. But actually, ultimately, the only thing they really have control over is hiring and firing you as the CEO. So you really if you do your diligence yourself and be very clear about this is our mission, this is our growth strategy, this is where we're trying to go. Don't take people's money if they want you to go into Walmart and you want to go into New Seasons.
So it's basically one of those like find the best fit VC versus.
I think that's right. And in the food space, there are a bunch of funds, Craft 3 all the way up to, General Mills, who are investing in companies, and they get that they don't know how to do this. That's why we're investing in rockstar entrepreneurs. And we're a friendly local investor, but I would really, if you start seeing red flags of like super controlling provisions in the documents you sign when you're working with the investor, or when those red flags about control start to spark, I would run away from those investors.
Thank you.
Yeah, you're welcome.
Shelli, let me ask you, lending, very different process. Can you kind of step through quickly, underwriting, closing, servicing, how that all works, and what the time frame is?
Sure. So our initial conversation, if you're looking for funding under 100,000, it can be a fairly quick process. You come in, we fill out the application. If our underwriters call you, you take those calls. And if everything goes smooth, you can have your business line of credit funded like within 5 days. And that would be anything under 100,000. But the moment you start, if you come in, you say, want to get a vehicle loan, great, let's get you a pre-approved so that when you go out, then you'll know how much what's your purchasing power. So it's kind of like you anticipating those loans also. If you are purchasing a building, I would say you want to give that 90 days. Because there are a lot of, obviously appraisals, inspections. If it's a gas station, we need to have, an environmental test. We need to, so depending on how complex the issue is. But, so when it comes to lending, you just want to see it forthright, that you know that you need it in the future, 2 to 3 months. If you need it in a shorter time, especially even if we're getting SBA involved. Because then SBA, you'll be filling out one set of forms for us, and then our SBA partner, you'll be filling out more forms with them, and we try not to have you bring in duplicate documentation, we will share what you bring in. But when we ask for documentation, because generally if it is a larger loan over 100,000, we'll need 2 years of your business taxes and 2 years of your personal taxes. And the same for all the partners that own 25% or more. So again, because we're looking for that secondary source of repayment. That's the reason we're asking for your personal taxes. But so depending on what you're buying really depends on the amount of time that it's going to be. A lot of equipment lending, if you are, purchasing a piece of equipment from Honda Motors or something, we'll work directly with them, and that will go fairly quickly because they'll send us the invoice and it will go through fairly fast. But if, again, it's that whole, if we're asking for something and you're not expedient in getting it back to us, it will prolong the process.
And can you comment, after the loan closes, the funds are dispersed, just the monthly bill, right?
Yeah, you get a monthly bill, we always encourage auto payment. In fact, most banks will even give you a discount if it's 0.25% to have auto payment. And you could always pay more. We would set up auto payment at the minimum amount, but we always recommend that you pay more. The faster you pay it back, obviously.
Can you modify, are there negotiations for the interest rate on those lines of credits?
The interest rate is really driven by your credit score.
Mhm.
So it's always prime plus a margin, and that margin is completely by your credit score. So if there is something on your credit score that we uncover that is an error, you need to get that taken care of, and then we will re-pull your credit. We just won't say, okay, we'll lower that rate.
That reminds me of another question. So are there restrictions on refinancing and stuff like that? Say you've got a business loan or business line of credit, you had $50,000 in debt, and then you wanted to refinance that to get lower interest rate with another company. Are there restrictions on who you can sell your debt to and stuff like that, or is that in that?
Nobody likes to refinance debt. If it's unsecured, if it was a vehicle or something, but right now in a rising interest rate environment, you're not really gonna see that. But I had a customer that I tried to refer her over to Robin, is they wanted to consolidate all their unsecured debt with Wells Fargo to make it one neat little package. Made sense in their eyes, but unfortunately, there's no such product.
And just a comment on that, there is some inherent risk when a lender is asked to refinance other debt. And in our case, we will occasionally refinance debt when the existing debt is prohibitively expensive. So we have one client that we refinanced their debt. They had some predatory loans. They were paying an effective interest rate of about 75%. This is humongous, and it exists out there. And that's my caveat: beware of those 48-hour, $50,000 tomorrow loans, because the fees and interests can be really expensive. But in that case, that loan was hemorrhaging their business, right? And we looked at the fundamentals of the business, it was, doing well if that loan was taken out. So we refinanced that, gave them some financial breathing room. But that's unique because we're a community development lender. A lot of banks, and traditional lenders will not touch, refinancing. We're, I know, we'll take one more question. I know you were in the back, had your hands up.
It's kind of a follow-up, on that, because you mentioned for younger businesses to take out potentially business credit cards. But now it sounds like you wouldn't be able to refinance that if you're using that as revolving debt. And so in this situation, if you don't have a predatory loan and you're in that situation, you just basically pay off the business credit cards before you're expected to try to find revolving, working capital, money for your inventory and other stuff.
Well, again, a credit card, we would be encouraging to use it for your day-to-day expenses.
Right.
Not for anything that's gonna be long-term. And most banks will have an introductory rate, and for 9 months, say it's 0%. And then I always tell my customer, take advantage of this, but pay it off at 8.5 months. Because that 9 months, that interest resets all the way back to the beginning. And so you just wanna make sure you really understand those terms. But again, yeah, a credit card I would not recommend if you wanted to go out and buy equipment with a credit card, because then we should be talking an equipment loan. A credit card is just your day-to-day expenses.
And I'll add to that is that I tell people, be smart with a credit card, because it's easy to get, right? And sometimes it's the only viable source of funding for a young business. But don't go grabbing, offer after offer, and then all of a sudden you find yourself having $50,000 in credit card debt. I've seen it, So, I think it's reasonable to have some credit card and some credit card debt, but be smart about it and keep it manageable and be able to pay it down if you're able to. And then that will set you up to be more attractive in the eyes of a lender for a bigger loan at some point down the road. So we're almost out of time. I just want to ask one last question. What is one piece of advice that each of you can offer to the audience, kind of given your type of financing?
Yeah, I can go. I'm always struck in these conversations when I meet all these awesome entrepreneurs that are in this room, kind of largely CPG because it's built up week, right? But I'm struck by like the incredible business opportunity, and I think to myself, why isn't there more money out there for all these companies? And I think the reality is that there are no good options for financing your business as an early stage company. And so it's really about understanding what are my least bad options and what makes the most sense for my business. And I know it can feel really frustrating as an early stage founder. And you'll get a lot of no's before you get some yeses, but think about those no's as a time to really understand why you're raising money and who it's from. And I think if you start with that why when you're bringing partners into your business or bringing, debt and equity into your business, those are, really understand why you're doing it, and then you can better understand what the implications are and how it's going to work for you and your business going forward.
And for me, is to really sit down with the banker and be just honest about your business. And Wells Fargo, and even if I wasn't working for Wells Fargo, I would still do a plug for this site. They have a Wells Fargo Works for Small Business. This is a completely free site, and it walks you through the beginning stages of even starting your business plan, and it's a work in progress. You can sign on to it, create a password, you could upload your logo to it. This is going to be your introduction to lending, because there are so many questions in here that it encourages you that you have 6 months of your personal finances put aside before you even get into thinking about opening a business. So it really gives you a lot of food for thought. And then it talks about, then it has this intelligence tool that you can put in the type of business, your neighborhood, and it pulls all your competition. And then it even goes into marketing, but even if like with taxes right now, that's just a hot button. You could search the word taxes and more than 200 articles will come up. So my suggestion is that you just do your homework. There is a whole section in there in lending, and it talks about from a credit card to an SBA loan and compares everything. And so my suggestion to you is just to do your homework before you get yourself into a situation that even if somebody says yes, and then you realize that you don't have a really good source of long-term source, being able to repay that back.
Great, well, thank you very much. We're out of time. I know I'll be around. I can't speak for Julianne or Shelli if they'll be around. We have this room till about 1:30, so if you have questions, feel free to talk to us. We'll send out contact information so you can reach us, separately as well. I want to thank Julianne and Shelli for being here.
Thanks, Robin.
And thank you for being here. And if you have any questions, let us know.